You're listening to the Financial Sense News Hour at financialsense.com.
But now the days are short. I'm in the autumn of the year, and now I think of my life as vintage wine from fine old kegs. From the brim to the dregs, it poured sweet and clear. It was a very good year.
Well, we move on to subject number 4 for our year-end summary, which I think we would have to categorize as being the spectacular rise and fall of silver and gold, with run-ups of both gold and silver at different times of the years, along with corrections. And there's a driving factor we want to discuss as well.
Yeah, I mean, if you take a look at, John, a little over a year ago, when we began with Bernanke's Jackson Hole speech in August of 2010, which kind of was a preparation for the launch of QE2, but it also launched the precious metals. In August of 2010, silver was sitting at $19 an ounce. Gold was in the low 4 digits. And we saw silver begin a rise from $19. It began the year at $31 and would rise by almost 50% to $49.50 an ounce on April 28th. Now, then, within a 2-week period, we saw a major drop of silver, down from almost $50, a 35% drop to $32. Now, there was a problem on the COMEX because at the end of April, over 1,850 contracts were presented for delivery, representing almost 9.25 million ounces of silver. And what happened is the CME raised margin requirements by 5 times in a 2-week period, and that's substantial, John. And it drove the price of silver down to about $32.70 within a 2-week period. So from its bottom, John, in April, silver spent most of the spring and early summer consolidating. And then as the debt crisis began to rise in Europe, and the problems with Europe, and then, of course, our own problem in solving the extension of the national debt limits in the month of August, it took almost 30 days, you saw the price of silver go from the low 30s all the way back up to about 44. And during that period of time, gold was also taking off because gold prices began the year at $1,427. They got to a high of almost just slightly under $1,600 in the first part of May, and gold spent most of the summer, like silver, consolidating until we got to the European problems and the U.S. national debt extension problems, where we spent the entire August where they were intimating that the U.S. was in danger of defaulting on its obligations. And from 1577, which was May 2nd, we saw the price of gold go all the way up to $1,925 an ounce on the first week of September, before the CME came in once again raising margins on gold and silver. And since that time, we've seen a spectacular drop-off in the price of gold. It began to rise back up towards its 1,800 mark. And then, of course, there's been a huge sell-off that we've seen, major waves of selling going on in the gold market as deleveraging, and especially with the European crisis becoming more prominent. And so we've seen both a rise and a fall in gold and silver. And as of the last day of trading of the year, gold is still up about 10% for the year. Silver is down roughly about 9%. It began the year at roughly $31, and it ended the year almost just slightly under, let's call it $27.71, just slightly below $28.
Well, based on interviews we've done with people such as Jeff Christian and other experts, you know, there continues to be record buying of gold in the markets, not just by investors, but also by central banks. What's interesting is we're not seeing an equivalent increase in the price of production. And there seems to be a split somewhere in here that doesn't seem to be corresponding, and that's confusing people.
Well, we've talked about this in the past, but if you want to look at the precious metals market, it's very important that you understand there's two sides of it. There's the paper market, which is the futures market. It's derivatives that are used by the bullion banks. It is the ETFs like SLV and GLD. In the paper market, John, is 100 times bigger than the physical market. I mean, we produce about 750 million ounces of silver a year. That's total production from all the silver producers in the world. We trade on a daily basis almost 1 billion ounces on the COMEX. And so a lot of what is going on in the price of precious metals, both silver, gold, platinum, is really being driven by the paper market. Because, I mean, if you look at the physical market, gold production is about 2,500 tons a year. Silver production is about 750 million. I mean, if you look at what we trade in the gold markets and the paper markets, futures markets, options on futures, the derivatives markets on gold and silver, it is about 100 times the size of the physical market.
Well, so we're seeing this disparity of paper to physical by about 100% as far as pricing goes, and investors continue to invest in the metals, but what is driving this disparity? Is it people speculating, fund managers? There's obviously a real cleavage here.
Most of the paper market is not driven by mutual fund managers, pension funds, insurance companies. This is what I call the hot money crowd. This is hedge funds and high-frequency trading firms on Wall Street, which is driving all of this. And you got to understand, when you're in the futures market or in the derivatives market, first of all, a futures contract, you begin with a 10-to-1 leverage. And there's ways to get around that and increase your leverage. As we found out with the MF Global, they were leveraged to 50-to-1. As we found out during the credit crisis in 2008, many of our investment banks were leveraged 40-to-1. As we're finding out with European banks, many of them are leveraged 50-to-1. And John, when you're leveraged that high, I mean, if you're leveraged 10-to-1, and just say you don't use any other leverage on top of that, a 10% movement downward in the market wipes out your entire position. And not only that, it would trigger a margin call long before that 10% move in the market downward. So a lot of this is high frequency trading. It is, the hot money crowd, because remember, money is looking for a rate of return at a time you cannot get a reasonable return on savings. The rate of return on savings is zero. It's negative when you consider the inflation market. However, and I think that it's sooner or later, this paper market is going to implode. And it's going to implode with the ETFs. It's going to implode in the futures market in the sense that you are going to see either deliveries not honored, just as contracts were not honored with MF Global. And I think that's one of the lessons here you got to be careful of. And I think that sooner or later, this is going to come to a head. You can't go on like this, trading 100 times the fiscal without some kind of disruptive event. I alluded to earlier, where in May of this year, there were a lot of contracts presented for delivery of silver. There wasn't enough silver that they could have got to rush to honor those contracts, so they had to move against those contracts taking delivery by driving the price down. Meanwhile, and here's something that's rather significant, the second largest economy in the world, China. China and India alone are accounting for 50% of the purchase of gold on an annual basis. China imported 86 tons, or close to 86 tons, by the third quarter of this year. China is the world's largest producer of gold, 13% of the world's gold production. In addition, they import 13% of the world's gold production. So between China and India, John, you've got almost 50% of the demand for the world's annual production of gold. On top of that, central banks have now become major purchasers of gold. They've increased their purchases of gold this year. As of the third quarter, it was 400 tons. That's a 10% increase in demand globally for gold this year. So if you understand that, in other words, you understand that the fundamentals are still there. They haven't changed. They've improved. There's greater demand for gold coming from countries like China, India, coming from central banks, and also coming from investors. That continues on a daily basis, unabated. There has not been a slack in demand. In fact, as prices have fallen, China and India have stepped up their purchases along with central banks of gold. I mean, they see it as an opportunity, especially with the European crisis. But it's the hot money, the high-frequency traders, the investment banks, and the hedge funds that are driving this roller coaster wild ride that we've seen both on the upside as well as on the downside. But the physical market is experiencing rising demand, and that hasn't changed.
I think the whole affair with MF Global as far as commodity trading and the whole scandal that's erupted, and we have James Katoulas on the program today to talk about that, where MF Global commingled its clients' funds and tried to play out there with their funds. It was commingled with the corporate funds itself, and of course the whole thing blew up in their faces. When it comes to precious metals, that still isn't the case yet, but it's one of the reasons why we have recommended to people that, people can't play with the metal you have in your possession. And if you are going to put it into storage somewhere, you'd better know with whom you have it in storage as well.
Yeah, you have to understand that these hedge funds who are clients of the major investment firms on Wall Street and the major investment firms are leveraged 12-1. The hedge funds are leveraged, in case of MF Global, they were leveraged 50-1. I would not have my gold on deposit on Wall Street. We use Fidela Trade, which stores gold and silver for the COMEX. They're not in any conflict of interest. They're not an investment bank. They're not involved in high-frequency trading. That's not their line of business. So that's why I think it's very important, as you pointed out, John, and what we've been recommending here on the program is, take delivery, keep it in a safe jurisdiction, because you don't want to bury it in your mattress in your backyard, especially as valuable as bullion has become. But you want to make sure that you vet the firm that you have it with, and I would not be with the leveraged firm. I just, I don't trust Wall Street. We've seen numerous occasions, and just listen to the interview that we have with James Katoulas in terms of what J.P. Morgan did in the case of MF Global. So that's why we always recommend you take delivery and find a safe depository. Keep it in allocated form. If you own gold and you're not being charged a storage fee, you're not owning it in allocated form.
Well, there's another aspect of everything we are discussing, and that is the gold mining indexes. They have not been going well this year. As a matter of fact, some of them are down 30 or 40%. Why are they not sharing the, should we use the word euphoria going on in the other areas?
Well, I think there's a number of reasons. Number one, we've had the risk-on, risk-off trade, and there's been, when the risk-off trade, it's fleeing anything that would be considered risky. I think also one of the plays that the hedge funds have used this year, and this is something I learned early on in the gold market, is you could be long gold like the bullion. And one of the ways you hedge against that is you may short the precious metal stocks. And one of the plays that the hedge funds have been using throughout the year has been shorting the gold sector. And you've seen this. You can just take a look at the short positions in many of the gold stocks. And there's also, in the case of the juniors, there's a lot of naked shorting. I can't tell you, in any time you see these convulsive downturns, the number of Rule 201s that go into effect, which is Reg Show, which is naked shorting. And, once again, the regulators are asleep at the wheel, and they're allowing naked shorting to take place. And that's one of the things that really is disconcerting for the U.S. markets, is the role that the regulators have not been on the job. Either they're short-handed, they don't have enough firepower, brain power, manpower, whatever it is, but they're not enforcing this. And it's what has happened is you've allowed a whole industry to crop up here, the hedge fund industry, that remains highly unregulated. It operates within its own confines and basically its own rules. It makes them up, and especially the bigger they are, the more that they can get away with. But one of the plays that have been all as a result this year is, I would say, the rise of the dollar, the risk-off trade has been one of the main factors that behind the underperformance of the gold sector. But, this is very typical. If you look at the last 10 years, there have been 4 periods of time where bullion has outperformed the stocks, and there have been 4 times where the stocks have outperformed the bullion.